In today's video, I'll be doing a step-by-step guide on how to sell cash secured puts on Moomoo. The cash secured put is one of my favorite option strategies because it is beginner friendly, easy to learn, and it allows you to receive option premiums while you are waiting to buy the stock at the price that you want. So what is a cash secured put? To put it simply, a cash secured put is selling a put on a stock that you wish to own 100 shares of, and by doing so, you will receive a premium. So you will need to set aside enough cash to buy 100 of the stock at the strike price if the option is exercised. So for example, Apple is currently trading at $214 and you wish to buy it at $200. Rather than entering a limit order of $200, you can sell a cash secured put at the $200 strike price and you'll get paid around $2.70 worth of premiums. And since each option contract represents 100 shares, this means you will get paid a credit of $270. Now, the benefit of the cash secured put strategy is that it doesn't matter whether the stock goes up, goes sideways, or even goes down. As long as the stock stays above the strike price by expiration, the option will expire worthless and you'll get to keep the premium. Once that happens, you can simply rinse and repeat the strategy to collect another round of premium. So, what's the catch? There's always a catch one. Yes, there is. And that is if the stock drops below the strike price and stays below it by expiration, the broker will automatically exercise the put option and you will now have to buy 100 shares. So in this example, this means you have to buy 100 Apple shares at $200, which means in total you have to come up with $20,000. But this isn't really a downside because you are okay to own the shares at $200 anyway. In fact, since you collected the $2.70 premium before this, your effective price for Apple is actually at $197.30, which means you just bought the stock at the discount. But wait, that's not all. Even if the stock goes below the strike price, you can still change your mind and you can adjust your position by rolling the option. Rolling just means buying back your option at the loss, then selling a new option at the same strike price or lower strike price with a further expiration date to cover your loss. For example, let's say you initially sold a cash secured put on Google at the $180 strike price, but the stock has dropped since. You could choose to roll the option by buying back your current option for $118, then selling a new put at a further expiration at say $175 for $250. By doing so, you not only move your strike from $180 to $175, but get to collect an additional $132 in credit. And if the stock continues to drop, you can keep rolling the option over and over again, maybe from 30 days to 60 days to 120 days and so on, until you are either okay with getting assigned or the option expires worthless. So as you can see, even though the cash secured put strategy is a simple option strategy, it is very powerful because with it, you either get the options premium or you buy the shares at the price that you want on top of a discount. However, with that being said, there are actually two downsides to this strategy. The first downside is that you have to wait until the expiration date to know if you get to buy the shares that you want. So maybe you wanted to buy Apple at $200, but even if the stock drops below $200, if it bounces back up before expiration, you will miss buying the dip. So if you absolutely want to own the stock no matter what, it's better to buy the stock directly. Second downside, you need to have enough collateral to buy 100 stocks. There are many people who treat selling cash secured put as free money, and they often ignore the fact that they need to have the money to buy 100 shares. So what they do is sell the cash secured put on stocks that they don't want to own in the first place and pray that the stock doesn't drop. Take for example, maybe they sell a cash secured put on Google and receive a credit of $191. In return, they only have to put up $2,296 buying power. So it sounds like a good deal, right? Because it sounds like they are getting a yield of 8.3%. But what they often forget is that if the stock goes all the way to zero, they could lose $16,309 for each put that they sell. If they do not have enough cash to take the shares, or if they do not have enough buying power to roll the put, they will get margin called and blow up the account. Now, obviously, the chances of Google dropping to zero is very low. But even so, there were periods when even a stock like Google could fall 50% or even more. So step number 1, only do cash secured puts on stocks or ETFs that you want to own. This means fundamentally good stocks or ETFs that you know are likely to go up over the long run. One fast way to check is by heading over to the company tab and looking at their financials. Fundamentally, good stocks are ones that can consistently grow their earnings, net income, and free cash flow over the long term. Obviously, you should do more research than that, like studying the business, what are its future plans, finding out its modes, and so on. But the earnings growth is a very quick and easy way that will filter away a lot of the bad stocks. Otherwise, if you are struggling with analyzing stocks, you can also use Moomoo AI to help you out. You just need to ask simple questions, and the AI will provide a comprehensive analysis of the stock's financial health, valuation levels, and key target price points. Once you have identified the stocks that you want to own, ideally, you will want to wait for a wave down pattern. That's because when the volatility increases, you get higher premiums. So, for example, here you have a wave up, wave down, wave up, wave down, wave up, wave down, wave up pattern. If I switch over to the Options tab, Analysis, and scroll down to the Volatility Analysis section, I can compare the stock price, which is the grey line here, to the implied volatility, which is the blue line here. What you will see is that in January and February, when the stock was on a wave down all the way, the implied volatility was shooting up. Then in April, the stock had a wave down again. The implied volatility shot up to its highest. If I had sold a cash secured put at that time, the premiums that I will receive will be very high. But now, since the stock is on a wave up, the IV has gone down, and hence the premiums that I will receive will be lower as well. So, if you want to receive more premiums when selling cash secured puts, it's best to do it during a wave down pattern. Pro tip: if you would like to better understand the relationship between IV and changes in option prices, Moomoo AI can also offer you a clear and detailed explanation. Step 3. Choose your options days to expiry. Some like to go for options with very short durations, like 7 days, because they get to collect premiums more frequently. But personally, I like to go somewhere between 45 days to expiry, because that's when the option's extrinsic value starts to lose its value exponentially faster and faster. Now, of course, the decay is the fastest in the final 7 days, but by then, most of the extrinsic value is already gone, leaving you with very little premium left to collect. If we open up Moomoo's option price calculator, we can see the impact of time on option prices. For example, if we look into the $170 strike price that expires in 37 days, the current price is around $8.55. However, when we adjust the expiration date to just 1 week away, its theoretical value is only $2.85, which is a drop of over 60%. That said, there's no strict right or wrong here. It really depends on your trading style and risk preference. So just go with the DTE that you're most comfortable with, yeah? Also, here's a very useful tip. Next to each expiry date, you will see the implied volatility listed on the right. This can vary from week to week, and some weeks will have noticeably higher IV than others. Take Nvidia for example. You can see that for the 41 DTE, the IV is a little higher at 45%, while the weeks before that are only around 35 to 37%. This is because during that week, Nvidia will be releasing their earnings results, and such events tend to increase the volatility. So if you're okay to own the stock regardless of the earnings outcome, this can be a great opportunity to take advantage of the higher IV to collect more premium. Once you determine your days to expiry, the next step is to select a strike price where you're comfortable with owning 100 shares. Again, there's no hard rule to this, but one tip that I have is to select a strike price that's below a support level. That way, there's a higher chance that it will bounce off the support and go back up. So, for example, here we can see that $295 is a good support because the stock has bounced off it twice. So, even if the stock were to drop back down, there's still a good chance that it will bounce back up again. And you either get to collect the premiums for free, or if you do get assigned, you will own the stock at below $295 and can profit if it recovers from there. Besides that, moving averages can also work as support levels. So in this case, you can see that the 100 days moving average has a support at around $295, which makes the $295 support even stronger. Now, of course, there's no guarantee that it will work every time, as support levels can break, especially when there's bad news. But this gives you a higher probability of profit as compared to blindly choosing strike prices. Other than support levels, another indicator that you can look at is the RSI. It will tell you whether a stock is overbought or oversold. For example, back in February, March, April, and June, you can see that when the RSI was near to 30 or went below it, the stock became oversold. and it bounced back up after that. On the flip side, if you try to sell a put when the stock is overbought, like in early June, the stock would have gone down and you would have gotten a sign, and it could take some time for the stock to come back up. So ideally, you want to wait till a stock is oversold or at the very least not overbought. Then sell at the strike price that's at below the support level. Pro tip: Moomoo's market position overview is useful for checking the support and resistance levels. You can also find the interpretations of various technical indicators via technical sentiments. For example, whether the RSI is currently oversold or overbought. Otherwise, you can also directly ask Moomoo AI to analyze the stock using technical analysis. Moving on, here's a quick demo on how to sell a cash secured put. First, you choose a stock that you are okay to own 100 shares of. Head over to the Options tab. Make sure you have selected Put. Choose the days to expiration that you want. After that, select your strike price. Since you are selling a cash secured put, you want to make sure it says Sell here, and you are trading a single option. Before even placing a trade, you can also pull up the bottom panel and tap on the up arrow to see the P&L analysis of your option strategy. For example, if I'm selling a cash secured put at the $150 strike price, and if the stock stays above it, my max profit is $250. My break-even price is $147.50, since the premium is $2.50. But if the stock goes all the way to zero, my max loss is $14,750. Besides that, if you tap on the tiny right arrow beside the option that you have chosen, you can also see its price history. And further down, there's a price calculator which you can play around with to see how the day's stock price, IV, and even risk-free rate can affect your option price. Anyway, if you're okay with this, you can tap on Trade. For price, ideally, you want to go for the mid price so that you get paid a little more premium. You can also tap on the Preview button next to the Sell button, and here, you can see an analysis of your strategy again, a preview of the fees, and how this trade will affect your account. Next, here are some very useful tips to know. Every month, you will get to trade 100 option contracts for free. You can check for this by going to Me, My Rewards, switch to Moomoo SG, and here, you will see your free Moomoo option commission cards. By default, you will be on the fixed option pricing plan. But if you often trade more than 200 options a month, it's better to switch over to the tiered pricing plan, as it will get cheaper the more you trade. To check which pricing plan you are on, or switch your pricing plan, head over to the Accounts tab, tap All, scroll all the way down till you see My Fees, tap on it, tap US Stocks, then tap on the Switch button besides the US option. And here, you'll be able to see or switch your option pricing plan. Next, Moomoo has a useful strategy tool, which can help to design option strategies based on your expectations for the stock price trends. For example, if you believe Nvidia will reach $190 by the end of August, Moomoo can suggest potential trading strategies and provide an analysis of possible returns. You can even key in your budget, and Moomoo can help you design the trading plan that you want. Additionally, you can also click on the Filter button for more options. In addition to the strategy tool, Moomoo also offers powerful options analysis tool to help fine-tune your trades. For example, it has trade stats, volume, and open interest by strike price, volatility analysis, and many other stats that you may find useful. Last but not least, over at the Unusual Activity tab, you will also find real-time data on large or irregular option trades, often placed by institutions or high-commission traders. This can often give you clues into potential big moves or market sentiment shifts before they happen. Anyway, that's all for this video. Hope you found it useful. Like, share, and subscribe, as I'll be posting new videos every week.